First of all, let's go back. I mean, we don't think we're entering a bear market. We think we've been in one. We've called it a rolling bear market, and we look at global asset markets. You can go back to basically January as the peak of euphoria, and really, Bitcoin peaking last December, kind of the ultimate spec assets down, 80%, and that rolled into emerging markets, rolled into cyclical stocks. I mean, banks have traded terribly all year, things like home builders, semiconductors, et cetera. And really, people didn't feel this in the U.S. until they started going after the large growth stocks, which is why we downgraded tech in July, anticipating, and small caps as well, anticipating that finally the rolling bear would get to these bastions of safety, and that's what's happening now. We're getting to this last part of the market that people have been hiding out in, and that's why tech is taking the brunt of the pain now. So that's the bad news. The good news is that we're probably 80% of the way done with this, and so just as people are kind of in the moment of recognition, most of the pain is already done. And I want to, define a bear market. It doesn't have to go down 20%. A bear market is just a market that's very hard to make money in, which is basically what we got. I mean, very few people are making money this year anywhere in the world.
You say we may be 80% of the way through, but this is still not a buying signal at this point. You're waiting for what? You think the outlooks for next year are still far too high, right, in terms of earnings?
Yeah, two things. So the reason we were probably less constructive than most coming in, the first one is liquidity, we think, is drying up more than people think. We're not as focused on the Fed rate hikes. We're more focused on the Fed's balance sheet reduction, as well as the ECB now tapering. We actually call that a tipping point in October, when both of those became bigger constraints. And then you're right, Becky, we're worried about next year's earnings. We've written about this extensively. We think margin expectations are too high. So we think there actually is a pretty good chance we could have a modest earnings recession next year, even if we don't have an economic one. And that's what the market's been telling us all year. That's why these cyclical sectors have been getting hit so hard.
So then, Mike, where do we reach some kind of point of recognition when a lot of this stuff is reflected in the markets? I know you said 80%, whether that's in how much of the decline has already happened or in time or whatever it might be. What gets you to that point where the market says, okay, we pretty much priced it in? Is it going to have to also require the Fed kind of stepping back a little bit or some other kind of catalyst like that?
Yeah, so we've discussed this as well, which is that we think there's three things that would get us more constructive. One would be if the Fed were to back off, and actually acknowledge that maybe financial conditions are too tight and they need to stop, that would be a very strong positive catalyst. We don't anticipate that anytime soon because the data is too strong. The other thing would be valuation. So we've written about this. We think 2450 on the S&P, that would be a place where you kind of really have to start thinking about stepping in, because even if you had an earnings recession next year, you'd be trading at a pretty low multiple on those trough earnings. So either valuation or you get the Fed to back off. Those would be two very positive catalysts from our perspective.
Hey, Mike, just in terms of looking at stocks, if you want to talk about this rolling bear market, you've got the value stocks that actually started picking up a little bit of bid. If you're looking for anywhere, you've got something like 50% almost of the S&P 500 that's down 20% or more. And that's the technical term, I guess the Wall Street Journal set to a bear market, down 20% or more. What do you start thinking? Or actually, I take it back, 78% of those are in correction territory, more than half down 20%. So where do you look in value? Are there places that you think are actually good value positions, or do you worry about value traps in some of those areas, or a reason for why you've seen so much carnage?
Well, that's right. We're looking at areas that have already taken the pain. So we made a shift in July as well, a little bit early, that we thought growth would underperform and value would start to outperform. We suggested that value would basically go down less in this last part and then would start to outperform. So we are looking at some of the value areas. We rotated more defensively in June, things like utilities and staples. That's worked pretty well, but they're getting kind of expensive now. And so we would start looking at maybe some of the financials again, some of the things like home builders, maybe even some of the semiconductors. But, you got to understand that in this last, sort of move lower, those things are going to get hit too. But those are the areas we would be looking to first. It's basically the rolling bear market going in reverse. So if the Fed were to back off, I think the market will start to buy the junkier stuff first, the more cyclical areas, as opposed to the growth stocks. So I do not anticipate that the growth stocks are going to lead even when the thing stops. You'll get bounces along the way, but we think the rotation towards value could be more durable than perhaps people are thinking about.